As a reminder, the presentation you're about to see is not legal or accounting advice. We encourage you to seek the services of a professional service provider to apply this content to your specific circumstances. And now I'd like to introduce our moderator for today's presentation, Bertha Minahan, National Practice Leader for Moss Adams Employee Benefit Plan Audits Practice. Bertha has over 15 years of experience in public accounting and has extensive experience directing all phases of audits for a variety of benefit plans, including 401k, 403b, pension, employee stock ownership, and health and welfare benefit plans. Her risk expertise includes the specialized knowledge required for audits, Form 5500s, and related filings. Bertha provides various consulting services related to the ERISA industry nationwide and dedicates her time to staying on top of the Department of Labor requirements while they're still in the proposal and discussion stages. So with that said, I'm going to turn this webcast over to Bertha to get things started. Bertha, the webcast is now in your hands.
Thanks, Courtney. Good morning, everyone. Welcome to our webcast. You know, this is a fun part of my job where I get to introduce some of my partners in crime who are truly experts in their field and have a lot of knowledge to share with us. So I'll start by introducing our speakers this morning. We have Dina Herbelich with us. Dina is one of our partners who has about 20 years of experience in public accounting. She serves as the chair of our Puget Sound Employee Benefit Plan Services Group. She assists with firm-wide benefit plan education and quality control. She's involved with retirement plans, health plans, including ESOPs. Dina is a proud recipient of our internal Moss Adams Technical Excellence Award for her knowledge of employee benefit plan industry. And Dina is a frequent speaker at conferences, including the Washington Society of CPAs, Western Pension, and our beloved AICPA, where she serves on the Employee Benefit Plan National Conference Planning Committee. So welcome, Dina. Next, I'm going to go to Wayne Field, and Wayne is a gem for us. He has a range of valuation services for operating companies, family limited partnerships, and limited liability companies, with a special emphasis on ESOPs. Wayne has obtained a designation of Chartered Financial Analyst from the Chartered Financial Analyst Institute and is also an accredited senior appraiser in business valuations from the American Society of Appraisers, and he is the past president of the Seattle chapter. He's written a lot of articles on the subject of valuations, and he's lectured a lot on valuations and financial analysis to a variety of professional groups. So welcome, Wayne. And last but not least, we have Michael Hall. And Michael has been in public accounting since '88, and his focus is providing tax and business planning services for middle market businesses and their stakeholders in the manufacturing and distribution, commercial real estate, and professional service industries. So Michael provides services to closely held businesses in basically every stage of life cycle, from planning for startup or growth ventures to succession planning for the business owners. Michael has extensive experience in corporate taxation, and that includes mergers and acquisitions, both domestic and cross-border. He has experience in partnership taxation with an emphasis in real estate, and the Foreign Investment in Real Property Tax Act taxation, and pretty much, you know, the U.S. tax aspects of international investment and transactions. So I think we'll welcome all our speakers, and you'll agree that we have a wealth of knowledge today. So today's webinar is going to be what we've named ESOP 101, which is really how an ESOP works. But as I'm advancing to slide 11, this is just the beginning. This is the first part of a three-part series that we are bringing to you regarding ESOP. So today we're going to lay the foundation. Then we have part 2 and 3, and we'll remind you about them later. We'll send you invites, all that good stuff, and we're hoping that you can be with us throughout the series. And the second one in December is going to more focus on the valuation side and understanding how to implement it. So it's going to kind of work on how the valuation process works, what goes into, you know, performing a valuation. Once a transaction occurs, what are some of the accounting implications? Then for our last part, which is going to be probably around the corner before we know it, on February 4th next year, that's going to focus on the plan side for an ESOP and what the DOL looks for and requires in terms of reporting. And then what the participants see in allocating stocks and, you know, what does the ESOPs do for corporate culture. So those are going to be coming up, and we wanted to make sure we share them with you this morning. So moving along to today's agenda, we're going to talk a little about, again, what is an ESOP, how do the participants benefit, We're going to talk a lot about how we establish an ESOP and if you are a suitable candidate. So I think this is going to be a really good foundation setting for our future webinars. Now moving on, we're going to start off with a polling question, as we like to do, to get a pulse from the audience. And I know this slide may have a lot of options, but we're trying to see what organization you're representing today, a C Corp, an S Corp, or an LLP. And of course, if you are a C or an S Corp, do you already have an ESOP in place, which would be the last two options. So that's what we're kind of trying to gauge here. I hope it's not too confusing, but it really helps us to, I think, know who our audience is. And the polls are going to be open for a little longer. Wow. I think we're kind of spread out still as the responses are coming in. Okay, and I think I can close the poll soon. Excellent, and the polls are closed now, and we have about, it's a little spread out evenly, but we definitely have more C Corps on the line, and over, I think, half of them have ESOPs in place, so that's great to see. So we're going to start our presentation now on slide 13, and I'm going to turn it over to Dina.
Thank you, Bertha, and thanks everybody for participating this morning. So the first item on the agenda, of course, is what is an ESOP? And I noticed that 22% of you, approximately, already have an ESOP in place, and perhaps some of you are part of an organization that is an ESOP, but you're new to the concept of ESOP. So we'll start with a little bit of the basics. ESOP stands for Employee Stock Ownership Plan, and it's a qualified, defined contribution employee benefit plan. And when I say qualified, I'm talking about qualified under the Internal Revenue Code for tax-deferred retirement benefits. So very similar to your 401k plan or your profit-sharing plan, an ESOP is a qualified retirement plan. The employer makes contributions to the plan. Participants earn value in the plan, and when they retire, they can realize that value, pay tax on it, and take their money for retirement. What's different about an ESOP compared to a 401k or other kind of defined contribution plan, of course, is that the objective is to provide broad stock ownership interest to employees. ESOPs are most commonly used to provide an exit strategy for departing owners or founders of an organization, and typically used as a way to motivate, retain, and reward the employees that helped make that business so successful in the first place. The ESOP, Employee Stock Ownership Plan, has a legal document, a plan document, and there's also a trust document. There's also a trust that is actually the legal shareholder of the plan, or of the stock rather. So the stock, while it is held in trust for the benefit of the participants, the trust itself is the legal owner. There's two types of ESOPs. There's non-leveraged and leveraged, and by leveraged we're talking about debt or borrowing. In a non-leveraged ESOP where there's no debt, you might see an employer fund an ESOP plan, and then the plan will use that stock to buy shares either on an open market if it's a public company or from selling shareholders in a private company. But more often when we see a transaction for an ESOP, we see a leveraged transaction where the ESOP will borrow money in order to buy stock from the selling shareholders. And over time, that stock is allocated to participants as the loan for that borrowing is paid down. And we'll go through some graphs coming up so that you can visualize that concept. But first, we're going to talk about some statistics about the ESOP companies that we see in the United States. Approximately 10,000 ESOPs have been formed in the United States, covering 10.3 million employees. Half of those are majority owned by the ESOP, meaning the selling shareholders have sold more than half of their investment of stock in their companies. And 4,000 of those 5,000 are 100% owned. This raises an interesting question. When the ownership transitions from the selling shareholders to the employees or to the plan, what happens to the decision-making process? And what you'll see is that the executive team, the management team of an organization is still in control of the company, and the board of directors is still making decisions, but there is some voting power that has been transitioned to the ESOP trust, and that voting power is typically controlled by the employees. So there is some delegation of decision to the employees, but for the most part, the business is still run as it has been by the management team and by the board of directors. Some other statistics, the ESOP Association, which, by the way, provides some education for their members and non-members who are interested in learning more about ESOPs. There's over 1,400 corporate members, but I found it fascinating that 72% of those members have less than 250 employees. So I think this shows that an ESOP strategy can be a good strategy for most any size company. I think there is sort of a bottom range where a company might be too small that it's not economical because there are some administrative expenses associated with an ESOP, or the structure just doesn't make sense from the selling shareholder standpoint. But the ESOPs represent a broad range of industries, the largest being manufacturing, followed by construction and engineering. And we typically see that ESOP lives are fairly long, that once a company makes a decision to become an ESOP, it stays in place for many years. Another factor to consider as you're thinking about becoming an ESOP, 90% of ESOP Association members also offer some other retirement plan, like a 401k plan or a pension, profit-sharing plan. And typically during the initial phase of an ESOP, where an ESOP is leveraged and the company is making significant payments on the debt, we'll find sometimes that the employer then will eliminate or reduce contributions to the other defined contribution plan during that phase in order to manage the cash flow. But the other thing that the employee foundation has found is that even if there is a second retirement plan, which usually there is, the members of ESOPs are typically getting a larger contribution through the ESOP than they would through another type of defined contribution plan. ESOP contributions tend to be about 13% of payroll and $4,400 to each participant compared to $2,500 in the non-ESOP defined contribution plan pool. And these benefits, of course, carry over to the business through better retention, lower turnover, typically higher profits. And we'll talk a little bit more about the statistics, and we'll walk through a transaction. But before we do, I think in order to really understand what an ESOP is, we also have to understand the tax benefits. So I'm going to hand the microphone over to Michael Hall to talk a little bit more about the tax advantages of an ESOP.
Thank you, Dina. As an incentive for companies and their stakeholders to consider utilizing an ESOP, Congress has created income tax advantages both to the companies and their stakeholders to consider using an ESOP as an exit strategy. The advantages are different depending on whether the employer is a Subchapter C corporation, which is a tax-paying entity, or a Subchapter S corporation, which is generally a flow-through entity and does not pay tax in its own right. With respect to C corporations, the selling stockholders have the ability to defer the income tax on the gain realized upon selling their shares to the ESOP by investing in certain qualified replacement property. And this is generally publicly traded corporate stocks and bonds. Not to go into too much detail here, but care must be taken with respect to the planned holding period for the new investments, because when the replacement property is sold, the deferred gain is recognized. So generally, the shareholders would be looking towards longer-term investments. At the corporate level, C corporations get a deduction for contributions into the ESOP used by the ESOP to pay debt interest on the purchase money debt. All dividends paid into the ESOP and all dividends paid into the ESOP, which are then in turn used by the ESOP to pay down the ESOP debt. So as a tax-paying entity, this effectively gives them the ability to reduce their income tax liability, which provides the company more cash flow then to grow and hopefully to assist the employee base as well. C corporations are, as I mentioned, C corporations are also allowed to deduction for dividends paid into the ESOP shareholder and used to pay down the ESOP debt. The primary benefit for S corporations is that as a flow-through entity, the tax is generally paid at the shareholder level. And in the case of an ESOP, which is a tax-exempt entity, its allocable share of the income escapes income tax altogether. So, for instance, if you have a 100% ESOP-owned S corporation, effectively the corporation's income does not get subject to income tax. And with that, I will turn it back over to Dina for our next polling question.
Okay, so I think this should be a gimme. Once an ESOP is adopted, a company cannot offer other retirement plan alternatives. Okay. I think that's pretty good, Courtney. We'll close the poll. And that's correct. Once you have an ESOP, you can still have other retirement plan alternatives. So I'm not sure if if there's a double negative here, but basically you can be an ESOP, and you'd have an ESOP retirement plan, and then you will also have your 401k plan or your pension plan on the side. Okay, so let's move on to a leveraged ESOP transaction. And we'll walk through this sort of bullet by bullet, but I also have some graphics. I also have some graphics that you can look at to visualize how this transaction works. So the first thing that happens is the ESOP borrows money to purchase stock. Now, this is really the only time in the qualified retirement plan world that you're going to see that a retirement plan can borrow money. Typically, that's not allowed. But the ESOP will borrow money to purchase stock. Now, the other thing to know about an ESOP is that even though it's a legal entity, it really doesn't have any means of paying for stock. And maybe I'll just step back. Once you have an ESOP transaction, you're really left with two entities. You still have your company that's either an S Corp or a C Corp, and you have an employee benefit plan, ESOP, the employee stock ownership plan. And the company really is the only entity that has the means to make payments on the debt. So typically you'll see a flow-through loan between the bank to the company and then the company to the plan, or you'll see guarantees by the company to make sure that those payments are made. But the ESOP, in essence, borrows money to buy stock from the selling shareholders. And this is really growing in popularity among privately held companies as a business succession tool and can be very effective in allowing the selling shareholders to remain some board level or executive level control over the company, but also to exit out financially so that they can transition into retirement. At the height of the last economic cycle and credit boom, we saw a lot of ESOP deals that were 100% bank financed, which is great for a seller because then the seller gets their money right away. The bank would pay the seller and the company would repay the loan. But with the tightening of the credit markets, we're seeing fewer and fewer 100% bank financed, if any, bank financed transactions. But we are seeing combination of seller financing and bank financing, and we do see a lot of seller financed transactions. If you've got a combination of both bank and seller financing for the loan, the seller note is typically subordinated to the bank debt. So usually you could negotiate a higher interest rate on the seller financing side. And seller financed transactions also allow for flexibility in the terms. So we might see situations where the ESOP transaction has taken place and then the company hits some kind of an economic downturn cycle. Either it's industry cyclical or there's something going on within the company that's making it difficult to make payments. So the seller financing can be flexible, where the seller can change the terms of the note, they can reduce interest rates, they could forego payments for a while, they could accept interest-only payments. Oftentimes the seller is very motivated to make sure that that company stays financially solvent and gets through whatever that downturn is, and so they're going to be highly motivated to be flexible within the terms. So once you have the note set up and the terms set and you've got your bank or your seller financing in place, the company then starts to make contributions to the employee stock ownership plan so that that plan then can service the principal and interest on the debt. So here's a visual of that transaction. On the upper left, you have your bank, or perhaps you have the selling shareholders. On the top right, you've got the company. The bottom right, you have the ESOP trust. That's the owner of the stock after the transaction. And then on the lower left here, you've got the transaction itself. So let's start with step one at the top, the company loan. In this step, the company will borrow money from the lender, either the bank or the selling shareholder. And we call this loan the external loan or the outside loan. The company, again, is the one that has the means to make payments on the debt incurred. So the lender would typically want to loan the money to the company as opposed to the ESOP. Although in a seller financing transaction, you might see a direct loan between the selling shareholders and the ESOP. But with a bank, the outside loan is definitely going to be between the company and the bank. And then typically the loan agreement will also have a stipulation to make sure that the company is making contributions to the plan in an amount sufficient to repay that debt. And step two is what we call the ESOP loan or the internal loan. This is where the company loans money to the ESOP, and the ESOP would then, in step three, use that money to buy the company stock. So now you have company stock in the ESOP, and you have loans between the plan and the company and the bank. And again, I'll say that the employees aren't individually the legal holders of the stock. When an employee terminates, they don't have stock to sell. They only have a beneficial interest in the plan. So to the extent that they have a beneficial interest in stock, they can sell that upon termination or retirement. But while you're an active employee, you don't have access to those shares for your financial resources. The other thing I should say is that the stock is being used now as collateral for the loan. So the stock is set up in what we call a suspense account. And as the loan is repaid, a portion of that stock is released from that suspense account and is allocated to the participants. And we'll show you how that works here in a second. So here's the loan repayment. Again, we have our company. The company makes an annual contribution to the ESOP. The ESOP makes its annual loan payment back to the company. And then maybe on the outside loan in step three over here to the upper left, the company will make its monthly loan payments to the bank or to the selling shareholders. And as that process occurs each year, the ESOP then can take a portion of the stock that was held in the suspense account and allocate that to the participants in the plan. Now, I'll point out that this inside loan can have a longer term than the outside loan. So your outside loan, say, might be a 7 or 10-year loan, and the company will make that loan payment, and the debt will be paid off in a shorter time frame. But the inside loan might be 20 years. The benefit to a longer term of the inside loan is that that allocation process would happen over a longer term period. So if you have employees that are employed when you become an ESOP, they will each get an annual allocation of the stock. But if you pay off that ESOP inside loan after 7 years, then all of that stock will be allocated to those employees. And you might want to encourage long-term employment, or you might want to be able to reward new employees who come in the 5th, 6th, 7th year of that ESOP loan. So if you have a 20-year amortization schedule for the inside loan, then employees will be getting a share of that stock over the 20 years. It will be a smaller share because it's spread out over 20 years, but it still gives you a longer period to reward the employees. Now, speaking of the employees, what are the benefits to employees? Typically, there's both monetary and non-monetary benefits. We talked earlier that contributions typically to ESOPs exceed those of traditional retirement plans. We see that employees in an ESOP, at no cost to themselves, get an ownership interest in the company, and they see an appreciation of their equity over time. And they don't pay tax on this benefit until a distributable event, such as retirement or termination. Non-monetary benefits tend to be a sense of ownership or pride in ownership, increased productivity and job satisfaction related to that sense of ownership, and more job security. The statistics show from this last recession that employees with ownership were less likely to be laid off during the recession than employees without stock ownership. And you can see some of the statistics here. Those are pretty impressive. Employee participation in this ESOP will look very similar to participation in another qualified retirement plan like a 401k plan. So you would have minimum participation requirements such as 21 years of age or 1 year of service. That service requirement can be less or more. The age could be less as well. The shares are released annually based on repayment of ESOP. When I say released, I mean transferred from that collateral suspense account to the employees. And in the example I gave earlier, in a 20-year loan, about 1/20th of those shares would be allocated each year. The shares allocated to participants are typically based on compensation. So an employee who makes $200,000 a year will get a higher percentage of that stock than an employee who makes $20,000 a year. The participants will receive an annual statement that shows the amount of shares that have been allocated to them that year, as well as the value, just like they would in a profit-sharing plan. And there's also vesting provisions that you can include in the ESOP. There's typically two types of vesting. There's graded vesting, such as 20% per year, and as long as participants are fully vested after 6 years, then you can use a graded vesting a graded vesting schedule. Or if you want to do a cliff vesting schedule, you could vest those employees after 3 years. So they would have no vested interest in their account until they've been employed for 3 years. Very similar to profit sharing or 401k plans. Here's a visual of what happens to the participant accounts. And again, we're just assuming a 20-year loan repayment. This is not how your company needs to handle it, but this is our example. And I've only shown every other year in this example, but essentially this allocation process happens every year. So even though the ESOP trust might buy 100% of the stock on day one of the transaction, that stock is not allocated to the participant accounts until the loan is repaid. And as the loan is repaid, a certain portion of the stock is allocated to the participants until they are 100% allocated at the end of the 20 years. If the plan were not leveraged and the company were just contributing stock directly, this would probably look pretty similar. The employer would probably not contribute all of the stock in year one. They would probably contribute a small amount each year until all of the stock that they wanted to allocate to their participants was allocated over time. The details of how that allocation works is going to be defined in the plan document and will be based on the Internal Revenue Code.
Dina, can I interject with a question before you do your polling?
Sure.
It was a clarification on your statistics that someone's asking before we move on to another part. And that was where you say approximately 10,000 ESOPs in America. We're covering about 10.3 million employees. And the viewer's asking, when you say 10% of private sector, does that mean 10% of all ESOPs or only 10% belong to non-public companies? So can you elaborate a little on what we meant by 10% of the private sector?
Go ahead.
Yeah, Wayne's going to answer that.
Oh, perfect. Okay.
Okay. This is Wayne. The statistics are hard to get on this just because most of the plans, as we presented in that slide, are for privately held companies, so it's hard to get good data. But the NCEO, the National Center for Employee Ownership, they're one of the organizations that help get this information, and along with the ESOP Association. So to answer the question, it is 10% of all privately held companies in the U.S.
Excellent. Thank you. So Dina, we'll turn it over back to you to finish your polling, which people have already started to answer.
Okay, so I think we will just give it a couple seconds here. Which of the following statements are true in an ESOP setting? The employees own the company. Employees vote on corporate decisions and are involved in day-to-day management. Employees must contribute money to the ESOP. Employees must be given company financial statements, or none of the above. And I think we'll close the poll.
Go ahead, Dina.
I'm sorry. So it's the beauty of a webinar. I had myself on mute, so I apologize for that. I'm sure you all heard what I was saying. So which of the following statements is true? Employees own the company. Employees vote on corporate decisions. Employees must contribute money to the ESOP. Employees must be given financial statements. None of the above. So our answer to this is none of the above. The employees, an ESOP is an employee stock ownership plan, but the stock itself is owned by the trust. And employees have a beneficial interest in those shares, and when they retire, they can take their shares, but typically, and we'll talk about this in a minute, typically those shares are put back to the company so that the company would then buy back the shares to allow for some liquidity for the employees. The employees don't generally vote on run-of-the-mill corporate decisions, and they're not involved in day-to-day management. Employees still have the same job descriptions as they had before. There are some corporate decisions that would be written into the plan document that might be required to put to a vote of all of the employees, but that would be company specific. Employees typically do not contribute money to an ESOP. You could have an ESOP that allows for employee contributions, but typically we don't see that. We do have clients that operate KSOPs, where maybe there's a 401k plan with employee stock in the plan. But more often than not, those are separate retirement plans. And employees are not required to be handed financial statements of the corporation. So that's why we've gone with none of the above on our answer here. So at the end of the day, the employees might want to take money out of the plan. And I mentioned this just a minute ago that the Internal Revenue Code requires liquidity for this stock, so that employees will have a put option typically written into the plan where they can, as they retire or terminate, they can put those shares back to the employer and allow for a liquidity event. And diversification requirements, this last bullet, for your employees who are older and who are closer to retirement, the IRS requires that you allow some liquidity in their funds so that all of their retirement isn't tied up in privately held company stock, which isn't necessarily a great diversified retirement strategy as somebody's nearing retirement. And with that, I'm going to turn it over to Wayne to talk about the last part of our presentation, which is, are you a suitable candidate, and how does the transaction work?
Thank you very much, Dina. Hello, everyone. Good morning or good afternoon, wherever you are. So we'll talk about some of the features that make you a suitable candidate for an ESOP. And judging from our first polling question, I think between those that answered already have an ESOP in place, or were a combination ESOP and CRS. It looks like S-Corp. Looks like about 45% already have an ESOP in place. But hopefully you'll have some information here that you find useful. And that you can share with your colleagues. So first of all, because most of the transactions that we see in an ESOP setting are leveraged, you want to have a company that can manage that leverage. So we want a company that is financially strong, its balance sheet has the capacity to take on additional borrowing. It has the cash flow, the earnings that will enable it to support that debt. And in both these cases, if you do have some debt already on your balance sheet, or you're in an industry or perhaps part of the economic cycle that your margins are maybe coming under pressure, your cash flow maybe is what it was at one point in your history, that's not to say you're necessarily precluded from an ESOP. What it does mean, though, is that the risk profile and your ability to maybe manage and service that debt increases. The other thing it does is that, all else being equal, when you look at a company and the enterprise value of the company, if you have more debt, that of course just means less equity value overall. So you could still maybe pursue the ESOP as an option. However, the equity or the value of the company that the selling shareholders are going to receive is going to be lower. And in terms of, we touched on some of the size restrictions maybe for an ESOP. Dean had mentioned that there are some limitations. There are no hard and fast rules on this, but we have some couple of rules of thumb that we see commonplace in the industry, and the NCEO sort of throws out some information as well. And basically, of these two bullet points here, the NCEO says that ESOPs work best for companies that have at least 20 employees. And where that becomes important is that, first of all, with that size of employee, you're probably going to be generating a certain amount of revenue and earnings, which means a certain value. And we'll touch on that next. The other thing is that there are limitations on how much a company can contribute to the ESOP in any given year. So if you have too small of a payroll base, it becomes difficult for the company to contribute enough money each year to amortize that inside loan in a sufficient amount of time. So that's why we see that sort of rule of thumb. The second one of revenues $5 million or more, again, just doing some back of the cuff calculations, that might imply hopefully a value of $1 million or more dollars. Some attorneys that we talk to, they even suggest that they don't want a transaction unless it's $5 million or more. So again, it's not a hard and fast rule, but there are professional fees involved. They can be fairly onerous when you're setting these up. We'll provide some more information on those as well. But there are some size limitations on the lower end. And then on the top end, there are public companies that have ESOP, so there's no limitation on the upside with respect to size. So some other points to mention here in terms of being a suitable candidate, and whether you're looking at the ESOP as an option or any other transaction to an outside party, these facts remain in place. First of all, you want to have a competent management team, not only with experience, but also with the depth, so that one person doesn't have all the relationships with your suppliers or your customers. That if that person were to leave, and this isn't necessarily just a salesperson, this could be just a selling shareholder as well. You want to make sure that this is a company that has the infrastructure in place, that upon a transaction and the selling shareholder and or owner transitioning away from the business, that those relationships remain intact and the company continues to operate in an effective and profitable manner. So you want to have that nice, strong management team in place. We do see as part of a lot of the transactions we do, incentives put in place as part of it to retain that management team and to incentivize them. That the whole notion of aligning the management team with the shareholders that you see in the public companies. So you'll see incentive stock options or stock appreciation rights that go along with these deals to make sure that those key individuals remain in place, especially right after a leverage transaction where there's all this debt, and you want to make sure that the company can navigate that period effectively. And there are numerous studies and information provided by the NCEO, the National Center for Employee Ownership, and ESOP Association that demonstrate that ESOP-owned companies tend to outperform their peers that are not employee-owned. But going hand in hand with that is that you generally won't recognize those benefits unless the company and management team is also committed to the concept of employee ownership. And some of the most effective ESOP-owned companies we see, they have ESOP communication committees where they really celebrate the employee ownership. They have contests to promote employee participation, and the winners, for example, will get to go to these national conferences in Washington, D.C. or Las Vegas. And at these conferences, they get to talk to other employee-owned companies. They get to learn some of the things that companies are doing to again, attract and create some excitement around employee ownership. And finally, Dina touched on this as well, but many or most companies are suitable candidates for an ESOP. It really becomes an owner decision. And there are pros and cons to an ESOP as there are with other exit strategies. So it really comes down to the selling shareholders deciding if this is something that they think they want to pursue and looking at basically all their options. In terms of the groups that are involved in a transaction, in a large enough deal, you'll have perhaps what we call a transaction quarterback or possibly even a financial advisor on the company side or the selling shareholder side. And in the vast majority, though, the sellers do not have their own financial advisor. Basically, there is one valuation firm that is hired on behalf of the trustee, and that valuation firm acts as the financial advisor to the trustee. They're the ones that are doing the valuation, which a trustee then uses to negotiate the transaction price. So what the transaction quarterback does, they're usually hired an individual or another company that is providing some consulting services. They will help with the facilitation of information between the valuation firm and the other ESOP side with the company. They will help review documents. They will help the owners or the selling shareholders become familiar with the ESOP and understanding what is going on in this whole process. On the ESOP side, you have a trustee. For all transactions, we do recommend that you have an independent trustee hired, at least for the transaction. This is where the most risk is involved, since this is where the transaction is consummated. This is where the money changes hands. This is where the most risk lies with respect to the Department of Labor, because they will be reviewing the transaction. And the independent trustees, the institutional trustees that you hire, they will ensure that they've done proper due diligence. They will follow the procedures, and it's very much a process-driven exercise that they'll be familiar with, that they make sure that it's done properly. And of course, there's the attorneys involved as well on behalf of the trustees, where they help draft documents and make sure that, again, all the due diligence is done and followed. The companies will probably also have some counsel as well. If you do have outside lending involved, of course, there's the bank and the bank counsel. And the sooner the better you can involve not necessarily people that have a direct impact on the transaction, but you have other stakeholders. And so you probably want to involve your CPA firm so they know what's happening. If you're in the construction industry, you might want to involve, or you should involve, or let them know your surety company, your bonding company, so that there's no business interruption, because your financial statements will be impacted significantly. And so any of those sort of stakeholders, we've had cases where, because this is technically a change in ownership, the landlord must buy off on the deal as well, because you in effect have a new tenant. So you want to make sure that all stakeholders are at least aware that a transaction might be happening. So what are the steps involved in establishing the ESOP? I think this first one, the selling shareholder, the owners, are prepared to sell the company, is probably the biggest stumbling block. Human nature being what it is, we tend to procrastinate and put things off until we absolutely have to act. And ESOPs have an extra wrinkle in a sense that, unlike a sale to an outside party where you can come in, set up the deal, negotiate a price, you get your cash, and you go. That's your kind of write-off in the sense of that's more your typical outside transaction. With an ESOP, because the vast majority of them are seller financed or portion seller financed, you tend to have the selling shareholders remain involved in the company until their note is paid off. They continue to groom and transfer relationships with the remaining management team. So not only do you have to get through that initial succession planning and estate planning stage, but you also have to be prepared for the fact that it's not a cut and run strategy, in a sense that you don't get your cash and you leave. There's an additional period afterwards. Feasibility study, what that is you'll have some third-party administrator firms will do these, or other consultants, and what they effectively do is they will have an estimate of what they think the company will sell for, kind of just a rough number. Based on that number, they will look at the company's ability to manage those cash flows, and then they'll look at maybe some tax strategies that the selling shareholder can put into effect to help defer capital gains. If there's any sort of incentive stock options or SARs or warrants as part of the deal, they will look at what that structure will look like. And so where the feasibility makes the most amount of sense that we've seen is where you have these additional incentives, where there's warrants involved, where the selling shareholder has to see other sort of financing techniques. If you just have a sort of plain vanilla ESOP, none of these other incentives in place, feasibility study may be not needed. And also, with respect to the company being able to manage the debt, most of the valuations are driven off of the income approach. So by definition, the cash flow should be there to be able to service the debt. So from that standpoint, the feasibility study probably won't add that much value. It's more when you get in these, again, the tax side of it, and these other more structured and finance and other incentives that go along with the transaction. Next, we touched on this already, but you want to let your accountant and your bank and your surety, et cetera, know the people that are involved in your operations, that they continue to provide the financing, that this won't disrupt your service. Next, you want to engage a trustee. So at this point, you're not necessarily committed to the ESOP. What we often see is an internal person is initially designated as the trustee, and what that does is it is that internal trustee that then engages the valuation firm. And the key for the valuation firm is to remain independent, and so we want to be engaged by the trustee at all steps throughout this process. So you just want to make sure you take a little interim step. Once the valuation is done and the sellers decide to go forward or not, if they go forward, that's when you probably as the company then hire an institutional trustee. That's when you also engage the attorneys. And finally, once the attorneys and all those parties are in place, the valuation is done, the transaction price is being negotiated, ultimately then the documents are flowing and are edited and come to final form, and you close the transaction. And it can take varying amounts of time, but 90 days from start to finish is a pretty good metric, not including that getting prepared to sell. That can take, that's very unique. That can take a very long time.
Hey, Wayne, this is Dina. Question on that last slide. When the internal trustee engages a valuation firm and then later hires an external trustee for the transaction, will that external trustee also get its own valuation?
In some cases, enough time will have lapsed that we will deem the valuation to be stale and it will need to be updated. And so you might keep the same valuation firm, but there's no guarantee of that. You don't have to. Some institutional trustees have more experience and more comfort working with certain valuation firms, so they might go out and get an entirely new valuation. That's not normally the case, but it is a possibility.
Thanks.
Good question. Finally, some additional information with respect to new ESOPs. Again, this is a function of the complexity of the deal, but typically you're going to spend between, at a minimum, $75,000 and $100,000 to set up the ESOP, and this includes the valuation, the attorney fees, the initial administration from the TPA. So that this hopefully will cover all costs. Now, again, it varies significantly depending on the complexity. You might be able to do it for less than $75,000. And we've had transactions where they're more complex. You have a lot more attorney time involved. If there's outside financing, the banks also have fees. They also have attorneys. So you're bringing more parties to the table. That, of course, means a lot more fees as well. So we've seen deals that are in the hundreds of thousands or even $1 million plus for a transaction. So it does depend. Once the ESOP is in place, you do have annual administration costs, typically just to cover the valuation firm and the TPA. And then if you continue on with the external or institutional trustee, they will have their fees as well. Hopefully, you're not spending more than $15,000 or $20,000 a year for all those parties. Again, depending on the size of the company and the complexity, it might be more or a little less. And just so you know, the Department of Labor, they will audit the transaction. There was a time when they were quite far behind, but we're getting ours generally done, hearing from the DOL within a year now. So they scrutinize every single transaction. You won't necessarily be challenged if they don't find anything that causes concern for them, but they are looking at every single one. So you want to make sure you hire experienced, competent people that make sure you navigate through this properly. And then so the DOL is the one regulatory body that is involved with ESOPs. The other one is the IRS. Where we see them more involved is with just the ongoing compliance and the administration of the ESOP itself.
You know, one thing, Wayne, that I always or sometimes find is that when the company has more than 100 employees, that ESOP itself also needs an audit. So I referred earlier to the two entities. You still have your corporation that will be audited and file tax returns, but now you have a retirement plan that also files a Form 5500 with the Department of Labor and potentially has an audit if it's large enough. So that's also part of that annual maintenance.
Right, absolutely. All right, with that, I'll pass it over to Dina for some final thoughts.
Well, thanks. I think what we'll do is move on to our final polling question for you. An owner will get a higher price by selling to a third party other than to an ESOP. True, false, or it depends? Okay, let's close the poll here, and I'm not going to answer that today because that is the topic of our future webinar series. So please mark your calendars. You'll all get invitations. Share them with your friends, family, neighbors, and we hope to hear you on these next calls. I'll also point out that I don't think we had time for all of the questions, but we will. We have record of who asked those questions, and we'll get back to you. And we'll also incorporate some of the answers to questions into our future webcast series. So thank you so much for participating with questions. Courtney?
Great. Thank you so much, Gina. Thank you again to Bertha, Dina, Wayne, and Michael, and of course to all of our attendees. As a reminder, if you attended today's presentation in a group being defined as more than one person, and you would like to receive CPE credit, you will need to complete the sign-in, sign-out sheet in order to receive that credit. As you recall, this sign-in sheet and a copy of the presentation can be located in the top portion of your screen by selecting the icon that looks like a free document. I'll leave the webcast open for another 10 minutes or so to give you the opportunity to download these items. And also please allow us at least 10 business days to process your CPE certificate. You will receive a survey link shortly after today's presentation. Please take the time to complete the online survey. Like Dina said, your feedback is helpful to us. Your questions are very helpful to us to help identify future topics. And again, I'll leave the webcast open for about 10 minutes here to let you download all those documents. And that concludes today's webcast. Enjoy the rest of your afternoon, and thanks for joining us.